The South African Reserve Bank surprised markets with a 50 basis point cut, alleviating cost pressures on households and businesses. The rate cut is also a welcome indication that long-term inflation is expected to moderate. For more on what this means for the fixed income market, Arno Lawrenz, Chief Investment Officer at Atlantic Asset Management, joins us from our Cape Town studios. And of course, Arno, following on from our conversation with Rod just a moment ago, we know you're a perma bear. So we're just going to go one way in this discussion, aren't we?
Not necessarily. As you mentioned earlier about the rand, it doesn't always go in a straight line, so markets don't tend to behave in the manner which we tend to predict because we tend to think linearly. So I think, it's one of those issues that if one thinks about the surprise rate cut that the SARB gave, perhaps the real surprise is what took them so long. In a sense of that, if one looked at the world, one could have said, well, we can see what's coming. So there's a linear sort of interpolation in a sense.
Well, on that note, do you think we're going to see another rate cut in the system, or is this really the bottom now?
This is one of the things that we've been debating, in fact, was that the market, as we sort of pointed out to you perhaps a few months ago, is that the market was overly pessimistic about inflation prospects in South Africa. And I think that's been vindicated, so the market has now come round to that. The FRA market had already basically priced in the prospects for a rate cut. So now we have the SARB actually cutting, perhaps a little bit earlier than what some of the pundits and analysts had forecast, although it was already priced in by the bond market itself. The next question is to say, well, what about the prospects for another rate cut? Because it's not as if inflation has now reached its bottom yet. It's not as if we even know where the bottom is, because the SARB itself said they're trying to be proactive, so they're looking at the scenario as it is at the moment. Now, all of the expectations that we would have is that things are probably going, and a good chance of that things are going to get worse going over the course of this year. How the SARB then reacts to that is going to be an interesting question. And already we've seen signs that the bond market will have no choice but to start to price in the prospects for another rate cut. In our mind, I don't think that the SARB is going to be in a hurry to do that, in much the same way as that they haven't been too much in a hurry to cut rates. Although I would say that if one looked at our peer group, whether you look at Israel, if you look at Korea, if you look at Brazil, they've been in rate cutting cycles for quite a while already. So I think the SARB really is going to play it basically as it lies, if you want to put it like that, in a sense, in golfing terminology.
Arno, Derek here, just a question from my side. Given the where we are in the interest rate cycle, and I agree with you, I don't think people quite know where the bottom of this interest rate cutting will be. So, and I think 2 years ago people were calling the bottom of the interest rate cycle then. So we've come down a lot lower than what people think. But if we sit right now today, how does one manage money? How do you look at asset allocating in this environment? You're not earning anything on your cash. There's a lot of risk in the equity market, so to speak, at this point in time. Do you see a fall out of bed on the equity side? Do you go and buy bonds at these rates? I mean, how do you asset allocate in this market?
Look, I think, Derek, what we try to do, well, at Atlantic anyway, is we first construct scenarios in terms of what we're expecting and try to attach some sort of probability to those. And obviously, one tends to then favor the scenarios where you have higher conviction. Unfortunately for us at the moment is we think that there's bad scenarios and good scenarios. Bronwyn, yes, we do have a good scenario.
Really, Arno, you surprise me.
They have fairly equal probabilities. And in that sort of context, what one tends to find is you have very different possible portfolio construction methodologies, in the sense of that you either end up with one thing or very different scenarios. So what you end up with binary scenarios. It's like gambling, effectively. But you tend to then find a blend of what we've termed in our investment strategy for this year is looking for safe income. So if you're an income investor, you tend to then look for instruments in various avenues that are offering you safe yield. So for example, at the beginning of the year, one looked at pref shares. They were offering very attractive yields, probably closer to 8.5%. If one then looks at where they are at the moment, probably on a tad on the expensive side. Listed property looked a little bit expensive earlier on in this year. Subsequently, they've moved in line with the bond market. And then you're left with cash, as Derek, you point out rightfully so, that on real terms, you're going backwards if you're leaving it in cash. So you have to then go, if you're moving away from a capital preservation stance, into something taking on some risk. I think that in the current context, what one ends up with is a strategy that says, okay, I have to take risk, but things could go wrong. Therefore, I have to remain with instruments that offer me higher degrees of liquidity. And then you can balance that out. So, for example, like government bonds. You can then balance that out with, for example, corporate credit and so forth, in particular with safe corporates that are, in this current environment, cost of capital is very low, very attractive for them to be able to expand if they find it necessary to do so. As far as your question is concerned on the equity market, I don't profess to be an equity market specialist, but I think the key thing here is that what we found is we're now heading towards a downward phase as far as economic momentum is concerned. The markets are still expecting corporates in general to offer great returns. Earnings are expected to still be very high. I think likely to be somewhat disappointed, but it's not an end of the world type scenario. You can construct that very easily, but we're not in the habit of trying to forecast black swan type events. So what you end up with is you have to be conservative and basically construct a portfolio of assets that meets your particular risk profile and that is effectively trying to avoid the risky assets that are illiquid. I think that's probably the sum total that you face with at this point.
Arno, I want to throw back to Europe and the possibility that Germany could exit the Eurozone. Wouldn't that actually be the best scenario, as you were throwing forward to in some of your commentary, that then perhaps we could see the rest of the Eurozone helping one another out, issuing Euro bonds, printing money, and perhaps getting through the downturn, Germany on its own, not having to bail everybody out? Wouldn't that make sense?
Yeah, it does make sense at one level. I think it is an elegant solution, and it's probably a solution constructed in the minds of analysts like ourselves who look at things on a simplistic basis and say, why doesn't Germany just do this? The reality of politics is that there are trade-offs, and Germany wants certain things. One of the things that they want is a weaker currency. So staying in this group of rats and mice of peripheral Europe, who basically caused the euro to be weaker than it probably should be if it was just the Deutschmark, actually does serve a good purpose for Germany. One statistic I can use in particular is if one looks at the job scenario in Germany. Go and look at the unemployment rates in Europe on an individual country basis. Spain, we know, is reaching into levels like 25-odd%, Portugal approaching 20%, etc., etc., and if one goes into the youth, even worse. But what is Germany's unemployment rate? Germany's unemployment rate is probably the lowest it's been for 20 years in the midst of a Eurozone crisis. I think the Germans are smiling and probably would say, actually, we quite like this scenario that we're in at the moment and that it keeps dragging on. We know that somewhere down the line, we'll probably have to pay something, but it's probably a transfer, in a sense, of current benefits transferred into the future. So I don't think Germany would want to go this route of going it alone, in a sense, of deserting and showing that they're deserting their European brothers and sisters in their times of need. So I think political expediency will force Germany to ultimately find some sort of solution, some sort of compromise, where they will pay, but they will extract something from these brothers and sisters of theirs at some point in time.
And then, true to my discussion on gold, do you hold gold, Arno? Do you think it's going to shoot the lights out, $2,500 an ounce?
It may well be even higher than that. It depends on which scenario plays out. In my mind, yes, there is a distinct possibility that things can go horribly wrong in terms of the Eurozone side of things, and its knock-on effect into China in particular. Ultimately, gold, we know, it's not just an asset that you bet on and think that, well, yes, it can go to $2,500, etc., etc. You know, if you construct a coherent investment strategy where you're investing for the future, for your retirement, whatever the case is, this is not gambling that we're about here. So you have to say, do we use gold as an insurance against an apocalyptic type scenario? I think yes, it does form part of such a coherent investment strategy for a large number of clients who perhaps don't have the ability to hedge themselves in any other particular way. So the possibility of gold going up to $2,500, $3,500, $4,500, some people have even called it to $5,000 over the next year or 3 years for that matter, is very distinct in a very particular scenario. And in particular, I think that would involve something like a China probably having a very hard landing, which would then have a very much a domino effect onto commodity producers like ourselves, back into Europe and into the US again.